Welcome to ETMarkets webinar. It is said change comes suddenly in financial markets. More often than not, they come without a notice. In many of the tier 2-3 cities where the mutual fund Sahi Hai campaign took off a little late, the ink on the walls are still very fresh. But here on Dalal Street, we see some signs of doubts, or should I say, lack of faith among mutual fund investors. But why? They say we can't trust debt funds. They say SIPs are not giving returns. They say some of them are saying now they want to pull their money out of mutual funds and put them in stocks directly. Recent numbers are even suggesting such a trend. Meanwhile, SEBI has just delivered one more disruption, and the industry is still trying to figure out what to do next, giving an impression to investors we do not have a stable regime over yet. Let's discuss all of this. We have with us Kalpen Parekh, President of DSP Investment Managers, a Dalal Street veteran of almost 2 decades now. Kalpen also had stints with IDFC Mutual Fund, Birla Sun Life Mutual Fund, and ICICI Prudential Mutual Fund. In the media, Kalpen is known for 2 things. He invests his own money in the funds that his AMC runs, and he talks investment in very simple terms with his kid Bihan and posts those videos on his Twitter account. What is not known much though is that Kalpen is also a very passionate behavioral finance expert. So when I connected with Kalpen for this webinar, I asked him what is really happening in the mutual fund universe. Distrust in debt funds and outflows from equity funds and investors complaining about smaller returns and all that. He actually cut me short with one simple sentence. It's all about good investing and bad investing. Let's make that the starting point of this discussion. Welcome to the webinar, Kalpen.
Thank you, Vijay.
Let's start at that point. How do you define good investing and bad investing and apply that definition to the puzzle that we have in the mutual fund universe today?
So first of all, Vijay, I like the way you set the context and laid out everything that's happening and the doubts which are there in the minds of investors and customers. And I want to just react to that before I react to the question you asked me. If markets have been around for 40, 50 years in India and maybe 100 or 200 years in the rest of the world, these questions and doubts that our investors are facing today have been there every few years. That is the nature of the market. That is not something specific only today, or that's not something happening only to us. It is the permanent nature of the market. And I'll try to summarize this in just 2 words. And these 2 words are markets fluctuate. That is the only reality of investing. That is the only reality of any asset class. Markets fluctuate, returns fluctuate, asset classes fluctuate, investor behavior fluctuates, flows will fluctuate. If any one of us are expecting that this will not happen to suit our needs, to suit our greed, or to suit our way of expectation of the market, you will be disappointed. You should not be an investor. The first rule of good investing is to be a witness to how markets work and to learn that this is the nature of the beast. Only when you know the nature of the beast can you make an attempt to ride the beast and to take help of the beast to achieve the goals that you have. So I think I just want to react to you by saying that good investing is about knowing the reality of the market over a long period of time and taking a full picture. What tends to happen, why do we get intermittently disappointed every few years, is because we always look at the picture today which is there in front of us. Ironically, why do we invest? And you spoke about my videos with my son. I keep trying to tell him in his own language, not my complex language of jargons, but in his own language, that you're investing for tomorrow. You're investing, for when you become big, when you are 25 and 35 and 45 and so on and so forth. So the result of your investments are going to be 20, 30, 40 years down the line. But the measurement of how to invest is done basis the last 3 and last 5 and last 10 years. So it is a fundamentally a broken template of looking at past to build our future. And if we can invert that, if we can understand that this template can, will never help us build our future, that to me will be the first step of becoming a good investor, which is realizing that what matters. Because what I've learned, and these are all my learnings from my own mistakes, and I must admit, with full honesty, that it's taken me almost 12, 13 years of being in this industry, facing markets every day, looking at markets every day, my own mistakes of people around me, which makes you realize that almost 90% of things that we track or that we look for don't really matter in the future of our capital. Why are we here? We are all here as investors to compound our money so that we retain purchasing power of our money. So whatever money we save, whatever money we earn from our salary, from our businesses, we want it to grow at a rate of return higher than inflation. Ultimately, that's what we want to achieve. We confuse this with so many nuances then by saying that I want to invest in a fund which is beating 20 other funds. I want to be in an asset class which is beating some 20 other asset class. These are things which will keep changing every day. Now, if we look at changing data points every day, we will never have a stable portfolio approach. And the first principle of good investing is to say, understand the market, the realities of the market, and then understand yourself, and then create a mix between the two. So for example, there are times when markets give very high returns, my portfolio does not, but I'm okay with it, because what I'm not okay is that when markets fall 50%, my portfolio also falls 50%. That hurts my ego, for example, or that disorients me. So then my design of my portfolio is a bit different. So I think once we learn the nature of the beast, and then we learn what are our own expectations from that beast, are they realistic, and then putting them together, bringing them together, and having an investment formula or a framework which is a durable framework is a very good starting point to not be a bad investor. Whether that will make us a good investor or not, I don't know. But if we can avoid being a bad investor, I think we would be definitely in the top decile of good investing.
Excellent. So I'll pick your point about intermittent disappointments, right? That's what you said.
Yes.
So I'll pick you there. 2 years back, when this entire reclassification of mutual funds happened, I remember some top money managers saying the good old days of double-digit returns are over in mutual funds, equity funds to be precise. Of course, we haven't had the chance to look up the industry, I'm saying, because we have had one after another headwinds. But really, is it something that we should come to terms with, that those old days of double-digit returns are gone from the mutual fund universe, or is it going to happen at some point?
So Bijoy, the quantum of return honestly has got nothing to do with the classification of schemes. In fact, I compliment SEBI for taking that first step of simplifying for the investor how to compare funds, because otherwise there were 500 funds with 500 different styles getting mixed together, and to analyze apples and apples was not easy for an investor. I myself would have not been able to analyze my own list of 15 schemes in DSP itself. But with this classification, you now are able to say which is an apple from DSP, which is an apple from some other fund. Earlier, we were comparing an apple and an orange, apple and a mango, and then trying to say which one is better or wrong. So this, I think, is a good starting point to make it easy for the investor, to make it easy for even platforms like you to compare funds and then look for what are good funds or what are funds which have not done well. So let me make it very clear: classification has got nothing at all to do with the returns of the asset class. The returns of let's talk of equity as an asset class. The returns of equity. See, forget funds. Look at Nifty. Nifty in the last 13 years has given 7% return. Now, there is no classification dimension to Nifty, right? It is its same old Nifty which was there for last 20 years. SEBI has done nothing for Nifty, but yet Nifty has given only 7%. And Nifty is the representation of the behavior of corporate India, the journey of corporate India, the journey of India's profitability and stuff like that. So returns are an outcome of two things. The returns of the market or a mutual fund or an asset class are an outcome of the growth. The drivers are basically the growth of profitability and at what price are we buying that profitability. So now, unfortunately, in the last, not just 2 years, but the last 3 years, 5 years, almost 10 years, or even 12 years, the profitability of corporate India has been muted, far more muted than what it was in the first decade. So in the first decade, 2000 to 2010, the profit pool of corporate India was growing like a rocket at 20 and 30 and 40% for 4, 5, 6 years at a stretch. And when the industry started, getting assets, was like in 2003, 4, 5, the valuation multiples, this profit pool, slow profit pool, was available at 12 P. And then the profit pool blasted. And then the P expansion happened. So we made 20% return till 2008 on account of two things: expansion of multiple from 11 times to all the way to 27 times. So 2.5 times return, 250% overall return came only from multiple expansion. And then the profit pool also grew. So that created a certain peak. Now, lot more money came at that peak, which is what it always happens. Money comes always at market peaks. When lot more money came around 2007, 8, 9, that was the last cycle, and now we are in this cycle. From that cycle till today, the profit pool of corporate India at large has not grown even a double digit. And multiples can't go to sky. From 25p, unlikely we can go to 50 and 100p at an aggregate market level. Some stocks here and there may, go. And some stocks are at high multiple, but at an aggregate market, which was at 25p, today is roughly around 28 or 30p. So more or less, room for multiple expansion for when you invest in a peak frothy market is always very low. Then you have to expect the market profits to grow. But even profits have not grown. So what has happened in the last 10 years? Some pockets have grown, like consumer companies have grown, pharma companies have slowly, started growing. And India was always seen as a consumer economy. Now, consumer companies have grown to a certain extent, but everything else in the benchmark, so large banks, except 2 or 3 big banks which have survived this, last 3, 4 years of consolidation, most banks had profit losses, had losses because of NPAs. Then large sectors like energy and metals had huge losses. Then another large sector like telecom had 30, 40,000 crores of losses. So if you take the aggregate profits of India, they have not grown. Now, if profits don't grow, why should Nifty grow? And if Nifty doesn't grow, now a good fund will say, okay, I'll not buy everything from Nifty, I'll cherry pick. So some funds have delivered 9%, some have delivered 11%, some have delivered 6% over the last 12 years. In the last 2, 3 years, something very similar. Again, in the last 3 years, at large, last year again, markets have remained on the higher side. They've been expensive, and so in summary, investors will make money when they buy at reasonable valuations and they get reasonable or high profit growth. But if we buy at very high valuation and then we get below average growth, then both become reasons for poor returns. And it's a cycle. So every few years, every economy will go through a cycle like that. So in the first decade, 2000 to 2010, the rest of the world was slow and India was growing faster. The rest of the world was well discovered, but India was not discovered. India was cheaper. I don't know when will we ever go back to 11, 12 P multiple. So I keep wondering that will we ever. So for us to make very high double-digit returns, we first need a massive bear market where current valuations come down, but then current investors will be unhappy. For future investors to be happy, current have to be unhappy. Or alternatively, for current investors to be very happy, which means markets go up, then future returns will not be very high because returns are cyclical. So all I'm trying to highlight here is that there's a lot of noise around on SEBI classification and all of that. Honestly, none of that matters. None of that matters in our returns. Our returns are a function of markets, of profits, and most importantly, they are a function of how we behave. So if we buy high and sell low, and then buy high and sell low again and again, we don't deserve to get returns. We deserve to get returns only if we behave in a very disciplined way and we acknowledge that markets will have fluctuations. During those phases of fluctuations, I cannot give up. If we get out when markets are cheap, when actually you should be putting in more money, we deserve not to make money.
Right. Of course, you have almost negated the impact of reclassification. But I still need to ask you a question about the SEBI rule about multi-cap funds. So you did this comparison about Apple and Mango, and when we actually looked at the multi-cap fund, the numbers, it showed these were basically large cap funds because the entire money was basically in large cap funds, right? So there, indeed, we were getting mangoes in the apples. Now, what does investors do if I have invested in a multi-cap fund? What is it that I should do? what would be your advice? Because over the next 3-4 months, the entire landscape is going to change, right?
So, Bijoy, first of all, avoid, not for you, I'm just saying at large for all of us, we should avoid generalizations that, multi-caps are large cap or so on and so forth. Because when you actually look at data, lot of multi-caps are roughly 65-35 in nature, 65-70 in large caps and roughly 30 in mid and small. The current reclassification, message from SEBI a couple of days back was largely on account of that 30% which is in mid and small cap. SEBI's opinion is that the small cap exposure is much lesser. Some funds have 2%, someone like us has around 10%, someone else has 12%, but at large it is roughly on an average around 7 to 10%. But the mid cap exposure is meaningful around 15 to 20%. So it's not a large cap fund completely. Now there are a couple of funds who are very large in size. Remember, see, if the job of funds is to also invest in good companies at good prices and not at any price. Now, good companies are not available in plenty. There are limited good companies world over and in India also. And as the industry size grows, as the fund AUMs grow, so we were 7 lakh crores 10 years back. Today we are 14 lakh crores on the equity side. The underlying companies also have to be really meaningful. Now, like I was saying, if the profitability has not grown, our universe to invest keeps narrowing down. We can't keep buying on loss-making companies in the hope that they will turn around. Like some of these wise investors always say, turn around, seldom turn. Very few of them turn. So when we are managing public money, we have to be very thoughtful where we allocate money. Number two, the pushback from SEBI or the message from SEBI is that in the non-large cap component, your exposure to small caps is very small. And the reason for that largely is because if you take the overall market also, the Nifty 500, for example, the market cap exposure of small cap in that Nifty 500 also is only 7%. So when I'm investing in a benchmark or around that benchmark, I will optimize around that. So if the underlying is 7 or 8%, I may be 10 or someone may be 2, depending on their ability to build the portfolio. Secondly, forget the benchmark exposure. Even from a profitability point of view, the profit pool of all small cap companies put together is less than 10%. So where is the profit pool for us to go overboard in a multi-cap fund? And we navigate. So there are times we may go from 10 to 15. There are times we may go to 5. So that is the reason multi-cap fund managers to a large extent have been operating more with mid-caps within the mid and small segment and less with small cap. And then secondly, the second important point, Bijoy, and to all the listeners is the returns is not a function of market cap. Long-term returns are a function of good companies. So if you get good companies in small caps, you'll make money. And if you get good companies in large cap, you'll make money. If you buy bad companies in large cap, you'll still lose money. It is, again, a generalization that large caps are safe and small caps are risky. In bear markets, the generalization is large caps are safe and small caps are risky. In bull markets, the generalization or the narrative is large caps are slow, small caps are speed. Just see how things change within 24 months. 3 years back, I remember DSC small cap fund in 2017, its last 5-year return was some 40%. It was rated as some best fund in the world by Bloomberg or someone. And people wanted to pump in money in that fund because the last 5-year returns were very good. So we had to shut the fund because we realized that we can't absorb so much money, because underlying small caps cannot take very large money. The free float in small cap companies is much lesser because promoters themselves own 60, 70 or 80%. And in good companies, in fact, promoters own more capital. They don't want to dilute their business. So when we want to buy such businesses, the free float is very less. And if more funds chase that limited free float, the valuations go up. So I remember in 2017, we actually shut the fund and a lot of investors were unhappy that, we want to invest, you're shutting. Now in April 2020, after a 40% NAV correction, when the fund is open, no one wants to invest because the last 3 years have been bad. Now, hence, all I'm saying is avoid the labeling of market cap to determine what will make money. Only good businesses will make money, or reasonable businesses whenever they are available in distress once in a while, when market is making a mistake and mispricing companies, and if we are able to pick them up and then play the whole cycle, those are 2-3 fundamental reasons to make money. There is no correlation of market cap to returns. In some cycles, small caps may make slightly more than large caps. In some cycles, large caps will make more than small caps at large. But overall, only good businesses will make money. Some of the largest banks of the country have not made money for 10 years now. because the profitability was challenged. So size has got nothing to do with returns. Growth, quality of balance sheets, quality of businesses, and what valuations we pay at the time of investing will determine future returns. I'll give you another example. I remember in 2000 when I just started my career, and the fashion of the season that time was technology funds, and a lot of world-class companies like Infosys, Wipro, they were all at 80, 90, 100, 125 multiples. In the next 10 years, they grew their profits at 40, 50%. But still, their 10-year returns were very average. So great businesses, great promoters created wealth in the first round. But for new investors who came at mispriced valuation, they didn't make money. So it was a great large cap company, but yet it didn't make a lot of money. It still compounded at 7, 8, 9%, similar to fixed income. So these are more nuanced drivers of returns of what will make money or not make money. Regulatory labels are important for clear segmentation, for investors to choose which fund sits where. Now, next question that you asked is, what do I do with my multi-cap, or what should we do? Now, let me just clarify here that, see, this has been an announcement just 2-3 days back, and there is a 6-month window, 5 to 6 month window for the transition, number one. So there's no need to really react or do anything in haste. Number two, SEBI also has mentioned that we are in dialogue with the industry to do whatever is right for our investors. While SEBI's first intent is clear, you should be true to label, which is a very acceptable expectation from SEBI. But the industry also is saying that we would love to be true to label, but there are certain practical nuances, particularly to put a lot of money in small caps in a very short window when everyone wants to buy small caps. So with adequate time and with the right fine tuning, it won't be an issue at all. So there are multiple options which will emerge in the next few months. Investors, I think, should do nothing right now, and I am not just preaching. I can only, if I have to show you skin in the game or commitment to this, in my DSP funds, while I invest in most of the products that we have, but my largest equity exposure is in DSP equity fund, which is a multi-cap fund. And me and my investment team discussed over the last 2 days, and we said we will do nothing right now. We'll wait and watch. Let's wait for a few days or weeks and see how SEBI's dialogue with the industry plays out. But in any way, our whole premise is that we invest around good principles of investing. It doesn't matter then whether I have to choose 20% in large cap, small caps, 25 in small cap, or 10 in small cap. That's secondary. We have a fairly large team to look for opportunities within small cap also. But all we were saying is we don't need to rush into it. And my advice to investors also will be not to panic right now. And I'm sure all. See, just because we are saying don't panic, don't take it at face value, because many times you take us at face value and your experience is not the best. But here, my genuine advice is don't react to technical factors. This is not a fundamental factor right now. It's a technical factor. Long-term portfolio changes should not be made on technical factors unless it's too dramatic. So I think just wait for a couple of weeks, and you have good people like you, Vijay, who will keep guiding investors on what to do, and we'll keep talking on this.
Great. We already have some questions coming in from the audience. We'll take them one by one. And meanwhile, I'll request the audience to use the chat box on the right-hand side of this app to keep posting your questions. Kalpen, I have one more question regarding this reclassification thing, which is that most investing books, when you read, they tell you any crowded trade will not make you much money. So when these kind of classifications happen, you have this kind of brackets, 25% will go there, 50% will go there, 60% will go there. Aren't we you are straight? So aren't some stocks getting overcrowded, which is of course is already showing in the market in terms of the index behavior, and will it eventually impact the return expectations?
I missed the last statement, Vijay. Is it your network or mine? If you can repeat the last slide, please.
Yeah.
You said trades don't make sense. Yeah.
Yeah. So I'm saying when you are straitjacketed into those kind of buckets, and there is so much money going into a certain bucket of stocks, these trades are getting overcrowded. So obviously the return expectations will have to be adjusted accordingly, right? So
yeah. So Vijay, I think the return expectation should anyways be moderated, not just because of this circular around small cap. Small cap is the last of probably worry right now. The overall market itself is crowded in few stocks. If you take Nifty itself, only 7 or 8 stocks have given all the returns in the last 4 or 5 years. So on the other extreme also there is a lot of crowding. If you take the frontline large cap Nifty, forget the small cap. The small caps have actually got decimated. Just the only problem of small cap is not just about valuations. It's about too much of money chasing it in very short time. So if there is ample time to build a small cap portfolio, which is what we otherwise do in our small cap fund, because we have enough time to curate the whole portfolio, it is not a matter of worry. But I think the larger reason why returns, in my view, in the future will have to be return expectations across all type of equity funds need to be moderated is because remember 10 years back inflation in India used to be 8 to 9% or almost 8 to 10%, and equities would earn around 13 to 14% return. So the real gap, real rate of return, equity returns minus inflation would be around 3-4%, or equity returns minus bond yields. Bond yields also were 9 and 10%. So equity returns, net returns over bond would be again 3 to 4%. Two things have happened in the last decade. Inflation has. Am I audible?
You are audible. I think we have lost your. Yeah.
Video. Okay, so I'll continue since I'm audible. I'll continue. In the last 5 to 7 years, inflation itself has come down significantly. Inflation is at 4-5%. Interest rates have come down to 6%. So equity cannot continue to give the same real return. As investors, we have to get adjusted to what is my real incremental return. So if my real incremental return was 3-4% then, and if it is 3-4% even now, it's fine. The absolute returns will come down. And again, it is not because of just crowding alone. It's also because of overall the earnings momentum in the economy is weak right now. And till that does not change, I think that's the more fundamental point. And that is a more fundamental point to solve for everyone, more than the labels, etc. Because if the earning the number that continues to disappoint, if the country grows at 5 or 6 or 6%, and you're buying that 6-7% growth at 30 times multiple or at 3.5 times price to book, then to that extent returns will have to get moderated. If the alternative asset classes are earning only 5% return today, the bluest of blue chip companies are borrowing money at 4.5% on fixed income. So if they are offering 5, why would stocks give 15? So I think the whole return curve has come down world over, and the same is happening in India. And here is where again for an investor, he should not make mistake of creating wrong expectations. Returns are a function of what you are buying and what are your other alternatives. So I remember we are in a zero interest rate world over. We are in a very, very low interest rate regime. So when everything has come down, the value of money is coming down. So returns cannot be too high. Highest returns are made, only when you buy something very cheap, which means you have to buy things in crisis, and that time no one has the courage to buy because data points are not there, clarity is not there. We are all very uncertain. So we make money for uncertainty. We don't make extra returns for certainty. For certainty, we will get fixed deposit returns or bond returns. Why should the market give us more returns if everything is certain? And today, so more returns are made for uncertainty. More returns are made when you have the courage to invest when it's a bear market, when 90% investors are exiting. So in reality, always only few investors make money, not just in this cycle. World over, if you see the power law, the base rates indicate that few people make money. Now, as investors, all of you who are listening, and if you want to ask that question that what will give me the right to be in that elite group of few people, that will, so then start analyzing what are their techniques of investing, what are their rules of investing, what is their discipline of investing. Are they the ones who buy at highs and panic within 2 years? I know so many friends and family members who start by saying my money is for 20 years, and in 20 days if markets fluctuate, they panic. So investing is a marathon, it's not a short race. Real return is made over time. So either we need to give time to our money, and we need to invest when markets are cheaper, more, or invest more when they are cheaper. Ben Graham has said that good investing is about buying investments or investing the way we buy groceries, not the way we buy perfumes. Now, when we go to buy perfumes, we pay any price. Price doesn't matter. But when we go to a vegetable shop, to that poor vendor whose livelihood depends on 5 and 10 rupees, we bargain for that 5, 10 rupees also. I've also done that. But off late, I've started now saying, no, let them in. So become a grocery buyer or a vegetable buyer in investing, not a perfume buyer.
Excellent. So let us check out what the audience wants to know. Can we get those slides, please?
Yeah.
So the first question, I have a dilemma. If many of the existing MFs choose to invest in the same stocks, how does the retail investor diversify in the real sense? What are the other investment options which one can expect?
So this is a question from Harkishan Murjani. So Harkishan, see, there is nothing wrong in more mutual funds buying some of the same stocks, because ultimately our fiduciary responsibility is to buy good companies. And if there are 50 good companies, and if DSP is buying that one good company, it's not wrong if my 5 other friend mutual funds are also buying that same good company. You can't say that diversify for the heck of it, because we all like those companies, so we'll buy them. If we never complain if all consumers are buying iPhone. We never say that why everyone is buying iPhone. iPhone is a good product, everyone will buy. So hence, so it is a reality that you will find a reasonable amount of common stocks in most portfolios. Now, how do you diversify? How do I diversify? Diversification is not about the number of schemes you own. The moment you own 15, 20 schemes or even more than 10 schemes, your average return will be less than Nifty, I can assure you. You can try and do that maths once. The higher the number of schemes, lower is your return. Generally, that's the correlation. So one approach is that you diversify on asset classes. Real diversification is buying a reasonable number of funds which are having different risk and reward profile, where risk and returns manifest in different cycles. So real diversification is some percentage in equity as an asset class, some percentage in bonds as an asset class, something in gold, something in global stocks. That is real diversification. A lot of investors confuse diversification by saying, I remember, someone recently showed me his portfolio, 53 schemes. I lost interest. I said, beyond 5 schemes, I can't even analyze. So that is not diversification. That is stupid investing. That's like, spraying your money and doing charity to every mutual fund. If you have to do that, you just buy simple Nifty, Nifty Next, or any passive index. You'll get better returns. So the right way of diversifying is to look for different asset classes and then ask this question that, okay, which asset class is relatively cheap, which asset class has better drivers of returns right now. So when equities are at a very high valuations or premium, that time let there be more of fixed income in the portfolio, or let there be a little bit of gold in the portfolio. There are asset allocation funds which do the job of diversification for you. There are equity and bond funds which shift between equity and debt at different points in time. So they give you, so my portfolio today, for example, has around 55 rupees in equity funds, has around roughly 15 rupees in global gold and global energy companies. So which is a very different diversification in commodity as a sector, because that sector is at a 10-year low. So when I look at returns of the energy companies, they are at 10-year low. You will not feel excited. I can assure you 99% people will say this is a bad fund, because 5-year returns are 0, 10-year returns are 0. Why should I invest? So it's a view that so in your portfolio, you should always have some money in something which is fundamentally good, but which is at a 5-year, 10-year low also, because then future returns can come there. On the other hand, the 50%, I have around 8-10% in the gold fund, which is at a lifetime high right now. So that makes me feel happy, but it may not give me very high returns in the future because they've already run up. Then around 30-35% is in short-term bonds, because that gives me the cushion. So even when markets fluctuate a lot, that component gives me some cushion. So that is my way of diversifying. Now, you don't have to diversify in the same component. It is a function of your time horizon, your understanding of the underlying asset class, and you should talk to advisors who can really understand your need and then give you the right medicine. Many times when people ask me, okay, tell me which fund should I invest in, it is as good as you bumping into some doctor. You go into a wedding and someone says this guy is a doctor, and you say, okay, which medicine should I take? So this question is the most often asked question, but it's probably not the best format. Because you need someone who understands. I cannot understand different investors needs and profiles. So a good advisor can help you say, okay, these are your time horizons, this is your risk appetite, and this is how your portfolio construction should be done. So diversify across asset classes rather than only across many schemes in the same asset class.
Okay, let's take the next question. From good returns and less tax impact point of view, should one invest in equity funds or debt funds? Because I think it's looking at the margin.
So Gitesh, see, first of all, investment should be done. So if you are doing equity funds, remember one thing, and this is a message to everyone, whichever funds you invest in, first question to ask is not, actually this is a wrong question. I'm sorry to say that. This question will not help you, Gitesh, because I'm telling you from my experience, this was the mistake I used to make till 2008. Always look for which is the fund which is giving the best returns, which is the fund which is doing well, and then you're putting more money there. And then when, like I said, asset classes have cycles, good returns are followed with bad returns, and again good returns, and again bad returns. So, the approach should always be that when you are looking at an equity fund or a debt fund, just pause back and say that, okay, let's say my horizon is 4 years. Ask this question: what is the worst return this particular fund has given on a rolling 4 year basis? So, if ever in the last 10 years or 20 years of the history of this fund, if I had invested in this fund for 4 years, what was the lowest return? So you'll realize in equity as an asset class, and you can do this exercise on Nifty itself. There are times for 6 years the returns are zero. There are times where 1 year return is minus 50, and then the next year it goes up by plus 100. But net you're still zero for 2 years, because minus 50 and plus 100 brings your capital just back. There are times where for 6-7 years the returns are less than fixed income. So you'll have to understand these nuances, that what are the worst returns in your desired time horizon. In today's context, if I have to give a very simple answer, I would say that you should split your money between the both. You should choose a dynamic asset allocation fund or a equity and bond fund, because it has debt and equity together. I believe that equity markets have run up a lot in recent times in anticipation of a lot of good news in the future. But the good news may or may not happen. Economic recovery may or may not happen at the speed at which the market is expecting it to be. So if your horizon is 10 years, you can be more in equity. If your horizon is 20 years, you can be again, 80% in equity. But if your horizon is 5 years, 6 years, 7 years, a combination of 50-50 in debt equity is a better combination to have rather than only one single asset class. Of course, in fixed income, you need to have minimum 3 years for better tax efficiency. In equity, anything more than 1 year gives you better tax efficiency. But in 1 year, the outcome from equity as an asset class is very random. The outcome is minus 55 and plus 102. That's the range of 1 year returns in equity at any point in time, worst case and best case. So stick to hybrid funds at this point in time is what I would say, keeping in mind that there are reasonable amount of uncertainty. Normally with this type of uncertainty in an economic environment, stock markets are generally very low. We are in a situation today because of a lot of easy liquidity all over the world, lower interest rates, other asset classes not doing that well. A lot of money has chased equity stocks world over and in India. So good companies are at very high valuations. There are enough companies which are cheap, but their business cycles are weak. So metal companies, energy companies, they're at 5 year and 10 year lows. But you don't know when will the cycle change. And again, it's like leap of faith. If it changes in 2 years, you'll make a lot of money there. But if it takes 4 years to change, you'll again struggle. So it's a very unusual environment. I've rarely seen a situation like this in my career, where huge amount of uncertainty, but markets are almost at all-time high. Or the stocks that we like to invest in are at all-time high. So stick to hybrid funds, dynamic asset allocation funds to start with at this point in time, which will have combination of equity and debt.
So it should be a mix. Right. Kalpen, I have
at this stage,
I have one corollary to that. When you say you look at past return, the experience has been the best performer of last year or maybe last 2 years tend to be probably mid performer or maybe a low performer next year.
Yeah.
So that presents a dilemma. So basically, when I'm trying to pick a scheme to invest in. My mind tells me go for the low performing scheme because they are under pressure to perform and they are going to go up next year. I mean, how does this equation work really? Why is it that we do not get that consistency?
So again, Vijay, see, every business has its cycle. See, what are we doing? We are taking money from investors and buying businesses. Now, if businesses have cycles, even funds will have cycles of performance. You take corollary of cricket. If Sachin was the god of cricket, even the god in 30% matches scored less than 30 runs, and he disappointed his fans. He was always expected, his bare minimum expectation was 100 runs, even if that's unfair. So even gods don't give you best returns every match or every year. There are great players who are permanently who have class, but their form can temporarily suffer. So even funds can suffer temporarily because our underlying businesses suffer, or the fund manager has made some mistakes. See, we will never go 100% right. We also have a hit ratio of 7 and 3. 7 out of 10, we get it right. We are very happy. 3 out of 10, we will also make mistakes. No fund manager has made. We talk of Warren Buffett all the time. All of us have his books on our shelves. His track record shows that over a long period of time, 33% of time he has underperformed the benchmark. Now, is he a bad investor? No. So I'm only saying, one, our expectation to expect consistency of outperformance every year is a wrong expectation. There will be cycles, but that's a reality. Now, what do we do about it? So what do? I say that I don't. This is what I'm trying to tell you is not very easy to do. It needs a lot of practice and a lot of discipline. Um, and I've learned this from successful investors. The way to think is that assume you didn't have the performance sheet. Let's say you were not given performance, and you have 5 funds to choose. You have one from DSP, one from let's say you have 5 funds in DSP itself to choose. I'll be happy if all of you invest only in DSP. Okay, you have only 5 schemes of DSP, and you know the portfolios, but you don't know their last 5-year returns. So you are not using returns as a driver to choose. How would you choose them? Ask that question to yourself. Now, then you will say that, okay, let me understand the style of the fund manager. Let me understand the behavior of the discipline of the fund manager. Is he a sensible fund manager? Is he a risk-taking fund manager? Does he have the right temperament? Or is he also like, any other retail investor who will buy everything in rising momentum when the tide is in favor and who will panic and sell everything in, a falling tide? So personally, I look at those things. Then I look at their documents. What are their investment philosophy documents? Then I also research what did he say over the last 5 or 10 years. Is he saying things for the sake of marketing the fund, or is he saying something which is sensible? How risk respecting is he? So there are fund managers who I like, for example, will always say that, okay, this is a good time to invest, this is not a good time to invest. Who appreciate risk, who are not always telling you that every day is a good day to invest, because so every day may be a good day to invest if you have money and if your horizons are 20 years, then it doesn't matter. But we realize our investors have only 2-3 years horizon. I would love them to have a long-term horizon. So ask this question, that can you do returns free investing? Without knowing returns, how will you choose? That should be your first level of evaluation. Then you are looking at more fundamental facts like principles of investing, risk of investing. Then you open the next page that, okay, now let me look at returns. Now let me see if this fund has been there for 20 years, what is its long-term track record of alpha generation, which is beating the benchmarks. So I'll give you one thing. When I chose one of the funds in my DSP bouquet, I looked at it that these were the 2 funds. Fund B was doing very well right now. If I'd asked anyone, they would have said invest in Fund B. But then I said, in its, let's say, 15-20-year track record, it has beaten benchmarks 55% of times. Though today it is doing very well, but 55%, so the odds are equal. 55% means 45% of times it will not. Then there was Fund A, where over its long history, it had beaten benchmarks on a rolling 3 or 5 year basis almost 75% of times. But currently it was underperforming. And then I said, when I analyze the style, I like both the managers, but one style resonated more with me. So I said, the style is resonating with me. The performance is right now low. So form is low. Class is permanent. The class is there. It has done well over a long period of time, but the current form is low. So today, let me buy the underperformance. Because if you buy past outperformance, more likely you will buy future underperformance. So you tend to revert this. These are some very loose principles of deciding how do you analyze performance. Then another ratio to look for is consistency of annual outperformance. How does the fund do when markets fall a lot? So when I have seen 3 market crashes, 2000, 2008, and now 2020. Now, most funds were not there in 2000, so but most funds were there in the last crash and this crash. You see, did they fall more than the market? If they fall more than the market, generally I would not put my money in. I would say that, okay, then you're not. It's basically playing momentum. It's not able to get out. So these are some of the rules that you look for. Then you talk to other wise investors who have survived decades of ups and downs, and you ask them what are your templates, and that's how you learn. You ask advisors. There are so many good advisors who can hold your hand and guide you towards this journey. So I think the way to good investing is inward. Don't do bad investing. what is bad investing is me in the mirror. When I look at myself in the mirror, I know at large God has made all of us bad investors by evolution. This is scientific. The human race has survived. There are 99% species have died. They've never survived. The survival rate is very low. Human race has survived because of the trick in the mind or the hack in our mind that whenever there is something, fear, we run away. Now, our survival instincts create problem for us in being a good investor. So in investing, we have to go against our natural instincts. So if this is my ordinary template, I have to invert that. So I always learn in this fashion. I say that, okay, left to myself, I want to buy best performing funds. So let me invert. Let me look for which funds are not doing well right now. Then I say that, are they robust? Do they have solid teams? Do they have long-term history? Do they have good investment process? Are they credible and honest in their communication? Do they explain risk to me upfront, or do they only talk returns? So there are funds where the conversation is all about returns, and there are funds where the conversation is a more balanced conversation. So in summary, Gitesh, sorry for such a long answer, but first question to ask is, which fund will have less return, less risk today? Start with that first. Don't start with where will I get good return. Start with where is the risk lesser. And the answer right now, again, as I said, is that a lot of asset classes are risky today because world over, a lot of money is chasing all asset classes. There is almost nothing today which is low risk in nature. Almost everything is at the higher band of its real price, and hence future returns in fixed income also future returns will be low. Today bond yields are at 6%, so you can't earn significantly more than that. 5 years back, 10 years back, bond yields were 9%. So when you invest in a 9% bond and stay with it, you earn around 9%. Now you invest in a 6% bond, you earn 6%. So we will all have to bring down our return expectation. We'll have to probably bring down our expenses and increase savings, and that's the best way to manage cycles like this.
I have to ask you this question, being a journalist, how important is it to be on top of the news cycle in the world of investment?
See, I don't mind me, but you may not like this because you come from the media industry. I read this article printed in Times of India, op-ed. It was an interview by Rolf Dovelli. And I believe even the chairman of the Times Group likes him a lot. He's a very reputed writer, and he's written a book called The Art of Thinking Clearly. And he says that there is studies done which says that if you stop reacting to news, your portfolio performance is much higher. So that struck me, and I started learning a bit more. And what he's trying to say is that whenever any item comes in news, it is known to everyone at the same time in today's hyper-connected world. So the news is getting priced in very fast. So reacting to news is reacting late because it is already in the price. If I know it and you know it, then everyone will know it. So we don't have an edge. So 10 years back, news was important from an investment decision making because information was important. Today, there is excess information. So what not to have becomes more important. So eliminating news which are not relevant becomes important. Today, behavior is a more important dimension than data. Data is ample. Today, everyone has data. Everyone has news. Today, you click. There are so many websites which give you data. So I think our behavior and temperament has a bigger role to play than news and data.
True. So one last question, because this gentleman Dave D has been sending so many questions. I had to take one of his. Yeah. How to swap from low return funds to high return funds? I mean, when, in what proportion, and over what duration? If your portfolio is already underperforming, this Dave D.
So Dave, I actually do the opposite. What I've been doing in the last 1 month is I'm swapping from high return funds to low return funds, because what is high has run up, and what is low will probably run up in the future, provided I know the underlying. So I know that I have 7 funds in my portfolio, and I broadly know all of them are managed well, but they have cycles. So 2 of my funds are growth style, 1 of them is value style, 1 of them is in gold, 1 of them is in fixed income, and 1 of them is in energy. Now the gold fund has run up like it is up 90%. So I'm removing from high return fund and buying energy, or I'm buying the value fund, which has gone nowhere for the last 2-3 years. So actually, it's the other way around. I don't have an answer how to do what you want, because I used to do that in 2006, 7, 8, 9. I realized that style of investment didn't work best for me. I do the opposite. Your question, first thing is to say, are your funds good? Are they managed well? Is the fund manager good? If the answer is yes.
Since 2001. So they say, the more boom and bust cycle you go through, the wiser you become. So do you think this bust cycle will leave us wiser in the world of investment?
Yeah, I think it is completely in our hands whether we want to become wiser or not. We have to constantly, keep learning and realizing that the market is bigger than all of us. None of us are experts, and most often we don't know the future. We don't know our own future. I don't know what will my company's profit be 2 years down the line, but we try to predict the profits of the 500 companies in the market and the 5,000 companies in the world, and then we try to, extrapolate. So real knowledge is knowing that what we know is always going to be a very small part of the larger universe, and then building rules around that. And I think every cycle teaches you new lessons. So we have to reflect and say, okay, what were the mistakes made in the last round? Keep minimizing those mistakes. I don't think we can ever become a perfect human being or a perfect investor. But if we are open, if we reflect on our decisions, if we make notes on our decisions, I have a notebook where I write that, okay, why did I make this investment? What was the logic behind it? And when I get out of it, I ask this question: that was my logic right or wrong? There are times I realize my logic was fundamentally wrong. How can I make a mistake like this? And then you say, okay, at least next time before investing, don't make that mistake. So my learning in this cycle again is, don't buy narratives. Don't invest in what is, very popular and very crowded. My biggest learning is have enough cushion through fixed income in the portfolio. Once every 8-10 years, large corrections happen. In those corrections, you should have enough money to put money in. So have good asset allocation. And it's very boring advice. Actually, a lot of people say that just to say that have good asset allocation, why do we need to talk to you? But actually, good advice is boring advice.
Excellent. I have taken extra time from you, Kalpen, but thank you so much.
It's a pleasure. Vijay, we are talking after long and really loved the type of questioning and the decades of experience that you bring to the dialogue. So thank you so much. Really enjoyed
Thank you so
talking to
much for your time, tips and insights, and of course the wonderful thoughts. I really enjoyed it, and actually, to be honest, I don't want to let you go right now, and I hope the audience liked it too. I have to close this discussion here. Of course, it remains conclusive, and we'll have many more questions for which we will be seeking answers from Kalpen another time on this platform or otherwise. So stay connected and keep an eye on for our next webinar, which we will announce shortly. Thank you, Kalpen. Thanks.
Thank you. All the best. See you. Bye.